All right, so I'm gonna start the unit on what I call anatomy of trade. The first lecture will be a forex view of trade, just to get some fundamentals out of the way. I think this what I'm about to describe is incredibly not well represented by almost any mainstream pundit, but I hope I can make it very easy to understand, and that will inform some of your interpretations when you read the news and investing generally. So yeah, what I have here is a very simple diagram that I've devised to explain what the basic anatomy of global trade looks like. So on the top, we have two squares. On the left, we have a square representing Brazil. Their currency is the Brazilian real, BRL. On the right, top right, we have a square representing the UK. Obviously, their currency is the Great British Pound. And on the bottom here, we have what I'm calling global finance. And this is denoted in USD. The reserve status of the dollar. I'll explain exactly what that is. But one of the features of the reserve status is that virtually all cross-border payments are facilitated in US dollars. So I'll show you what that means. On the middle, I have an arrow which represents a particular trade that occurs between Brazil and UK, namely the coffee trade. So Brazil is a net exporter of coffees and it exports coffee to the UK. So on the UK side, the buyer might be like a Pret store, and the seller, let's just call it the farm. So what happens with this coffee trade? Well, the farm is getting paid in Brazilian reals. That's how they make their money. That they live in Brazil, they need that. They sell their coffee for Brazilian reals. So what that looks like is from the perspective of Pret, the buyer, they are selling their Brazilian real, and then they are buying coffee. Okay, but where does this Brazilian real come from? Well, it comes from the forex market. So there's another arrow over here where you need to actually acquire Brazilian real in order to sell it to the farmer. In order to acquire Brazilian real, you actually need to sell the reserve currency, so USD. All right, but then where do you get USD from if you're British? Well, the only you could potentially have USD already, but regardless, most of the case you would actually need to get USD by selling pounds. So over here we have an arrow, which is buy USD and sell Great British Pound. So the entire transaction actually looks like this. There's actually three legs. The Pret needs to buy the coffee with pounds, and the farm that sells the coffee needs to receive Brazilian real. And the only way this can actually happen is through this FX intermediary, which almost always, in fact, goes through US dollars. There are cases where it doesn't, but for the purposes of this, let's assume that it does go through some third currency, and most of the time it actually does in real life. Okay, so that is the basic anatomy. Let me show you another version of this, but maybe going backwards. So I'll use a different color for this. Let's see if this shows up well. All right, red. This is the service trade. All right, so maybe you may have heard something about this. So what does this look like? Well, maybe the owner of the farm, it's quite a wealthy Brazilian man, wants to invest in more lucrative markets. Maybe he wants to invest in the FTSE 100 at the UK's benchmark index. So maybe he would call up his friend at Jardines in London, and he would ask, oh, I want to invest in the stock market. Jardines, being a broker, would clearly have inventory and be willing to give it to him through exchanging with the local market. And what that trade looks like is there's a buy FTSE 100 from the perspective of the farm owner. Of course, he's selling Great British Pounds to Jardines. And we have a sort of reverse arrow operation here where the Great British Pound needs to be bought in exchange for dollars. The dollars need to be bought for real. So this is a service trade. It is from a monetary currency perspective, it's the same as a export from the UK to Brazil. This service trade can be anything. This could be, I mean, maybe the Brazilian wants to contact a London hedge hunting firm to recruit, as that's a service that the UK is very well known for. Maybe the Brazilian is hiring someone for remote work in the UK, although I'm aware that that's not as common maybe as the other way around. So this could be anything. The point here being it actually has the same basic format as the goods trade. And what do I mean by that? So let's compare these two and consider the net account of the real economy for each of these trades. And by real economy, I will refer to, in the case of the white trade, the goods trade, the Pret and the farm. So what is the net change in their positions together? Well, they're actually flat coffee, right? I mean, maybe there's some loss in the shipping, but ignoring that, the Brazil farmer has the coffee. He loses the coffee, but he gives it to the Pret in London to sell. So that's actually a net flat position. There's no USD involved directly. If we naively assume that the two arrows at the bottom are equally matched in terms of notional value, and there's no slippage cost or transaction cost, there's no net USD position. What is the net position though is that there's a net short position in pound for the goods transaction, and there's a net long position in Brazilian real. Okay, so that is just, we're taking account of what both the two players in the real economy have before and after the transaction, and that's what you get. Now, what's the net account of the financial sector? Well, this is going to be the exact opposite of the real economy. And, well, so it's going to be flat coffee in USD. Well, coffee is not even really an asset of the financial sector. It's completely financial. But the monetary positions are the opposite. So long Great British Pound and short Brazilian real. And this here is the fundamental difference between trade between countries and trade within countries. When you trade within a country, you do not have this net position of currencies built up in the financial sector because you don't need to change the currency. But for trade that goes across countries, there is a net currency position that builds up. And so traditionally, this is viewed with some suspicion and maybe sort of behind some of the reasons why Trump has this view on tariffs, but we'll get into that in a bit. Of course, what many people criticize Trump say is that Trump is ignoring services trade. So let's do the same exercise here on the net positions with the services trade. So once again, we're actually flat, USD, and the product being traded, right? The FTSE 100 share, or let's say it's an ETF, is just changes hands, right? So the Jardines goes to the open market to buy it, and then Jardines gives it to the farm owner that wants to invest, right? But once again, we have actually the net currency positions, but in this case, it's a net long pound position and a short real. And this is this is just the opposite of the previous reaction. And then similarly, in the financial world, we have the opposite. So short Great British Pound and long real. Okay, So obviously, the complete set of trade between the UK and Brazil does not include more than just these two transactions. So I invite you to imagine in your mind's eye that we sum across all products and goods and services across all countries. So sum all countries, all trade. And with the UK specifically. And what we get at the end of this is a sort of a net position on pounds, at least from the UK's perspective. So it's net, in real life, it's actually net short Great British Pound. And of course, on the other side, on the financial side, it's net long Great British Pound. Of course, there's the other side of this, of the Britain's trade with the world, right? There's a net Brazilian real position. There's a net euro position. There's a net, yen position, and so on and so forth. But you'll observe that if we just consider Britain's currency position, there's the other side of its currency position with its trading partners, but really those other sides of the currency position with its trading partners are just part of the other partner's overall position. It's sort of like a double counting game. It's left as an exercise to the reader to convince yourself that's true. But anyways, this net position on pound is called the balance of payments. Okay, this is a very, very wonkish term that no one seems to get in the popular media, and I didn't get for a long time, but this is basically it. We're basically taking a close look at every single transaction across all borders with respect to a given country, and we're adding up the net payments, and hence it's called net balance of payments. And notably, the balance of payments has a net position on finance. So this might be kind of hard to imagine, but you individually might transact with a given broker to exchange your pounds for other currencies. But you might say that broker individually is going to be flat at the end of the day. But ultimately, there's nowhere else to push on this position to. He can sell it to another broker, but at the end of the day, someone holds in that position. So there's a net financial position represented down below this line. And this net financial position aggregate across all countries becomes something interesting. So now for the next section, I will make a new representation. Okay. So this is, imagine a long line of linear cells, A, B, C, and we'll call this Z over here. So this is country, right? Country A in this cell in the middle, country B is to the right, country Z is to the left, and then country C and D and so on. Just imagine this long ring of cells, each representing each country. The bottom, we have, of course, global finance. And for each of these cells, I'm going to imagine that I did this summation up here for every other country it trades with. Right, so we're going to have a circle here representing the private and public sectors. So basically the entire economy. And, this is going to be a circle for country B. And this is going to be a circle for country Z. And this is going to have a net currency flow as a result of the balance of payments. So, and similarly, B is going to have a net currency flow, and Z is going to have a net currency flow, and so on and so forth. And approximately, if a country cannot spell today. Runs balance of payments deficit. Right. What does that mean? It means the economy is selling their own currency. And finance is accumulating it. Right. And then similarly, for balance of payments surplus, we have the economy is buying its own currency, and finance is dispensing with. Sorry for the overbearing language of this. Overbearing language with that. Dispensing with. So, and basically every year the financial industry has to absorb these balance of payments. And here's the thing. When, so let's call this case like D for deficit and then S for surplus. So what are the consequences of D? And here we'll get into the need for foreign reserves. Consequences of D are that finance has a lot of your own has accumulating your own currency. Therefore, the price is decreasing. And the reason for this is you can think of it as a supply and demand argument. Because finance is accumulating your currency, there's more supply, so therefore the price decreases. You can also think of it as a portfolio hedge argument, which I'll probably explain in one of my other videos at some point. But basically, if the net portfolio position of all the financial firms is increasingly long your currency, then they're more and more exposed to the movements of the currency's value. So they're going to ask for larger and larger premiums to play as a market maker, which means that they're going to quote their quote their bids lower and lower. But okay, anyways, that's a different argument, kind of complicated. Supply and demand, if that works for you, that works. Okay, so if you're running a deficit, the price of your currency is decreasing. And this can be seen as inflationary. And what can you do about it? Well, there's actually quite a few things you can do about it. But one thing is that the central bank can act. Well, it's mainly actually the central bank's job. So I'm going to represent the central bank with the square. Central bank. And the central bank is special in that the central bank's job is to maintain control of the value of the currency. So when the currency is decreasing, the central bank doesn't like this. It sees this as inflationary, and it can do one of two things. Firstly, it can raise interest rates. But I'm sure I've covered this in another video. But for the purposes of Forex, the important thing here it can also do is the central bank can sell its US dollars. And it can basically reclaim the excess, if we're talking about Britain here, the country A is Britain. Britain's running a deficit. Running a deficit means that it's pumping out pounds to the rest of the world. Pumping out pounds means the price is decreasing, and the only way to sort of one of the ways to claw that back is that the central bank of Britain can sell US dollars and thereby drive the price of its own currency up. If you sell US dollars for pounds, you're decreasing the price of dollars, so you're increasing the price of pound. And this, costs reserves, dollars. And this is where the idea of a reserve comes in. And okay, let me get back to this, and let's talk about consequences of S. So consequences of surplus. So this is the inverse. So the price of the currency increase. And this can also be seen. This can be seen as deflationary. So what do you do? What do you do here? Well, what you do here is that the central bank can just print more of its own currency. That's it. So the rule here, right, is that in each country, a central bank has the power to print its own currency at will. That's how almost every currency works. But what the central bank cannot do is they can't print foreign currencies. So when you're in a surplus, the central bank's job is actually pretty easy. It can merely just print currency. It can use that currency to buy US dollars, and then thereby increasing the price of US dollars, thereby pushing down the price of your currency. So this side, the surplus side, is actually relatively easy and safe. It's the deficit side that's a little more dangerous because you can't print US dollars. The only way to sort of drive the price down by manipulating currencies is to sell your US dollars or any other foreign reserves. And all central banks are sort of constantly in a dance between these two options. The surplus option is obviously the easier to deal with, and this is sort of why a sort of traditional economist would say you always want to be in surplus. But of course, not everyone can control their entire economy, so what all central banks do is they all accumulate reserves just in case it comes the day that it needs to defend its currency. All right, because if you can, you don't need to accumulate your own reserves because you can always print that whenever you need. The thing that's rare and the thing that's scarce, from your perspective, is the foreign reserve, or in this case, the U.S. dollars. So this is the fundamental reason why in a crisis, traditionally before 2025, USD goes up. Because no one knows what's going to happen at the end of the crisis, and everyone is preparing for the worst case scenario, which is deficit. So all the central banks will basically go and sort of shore up their US dollar reserves, and this will drive the price of the US dollars up. So that is sort of the normal functioning of a the US dollar system. But this is actually not what we see right now, which is why everyone is so scared. And I think, so just one final note, I think what really gets people about this whole idea is that they think that currencies like magically transform from one to another, but that's just simply not how it works. Like you can't turn a silver atom into a gold atom. If you want to change your silver for gold, you go to a shop where the little man in the shop keeps a lot of silver and a lot of gold, and he can change it for you. But he doesn't do it by like converting one at a nucleic, like adding protons to the silver or removing protons from the gold. And I think what a lot of people think about global trade, what they see is they only see above this dotted line, and they don't see what's happening underneath. They don't see the whole picture. And I just want to point out that like in this system, I've written all these things strategically. Pounds only exists in the top right corner. If you observe around the arrows, pounds only exists on the top right corner. Reals only exist on the top left corner. And conversely, dollars only exist below the line. So basically all these countries, these currencies are akin to like semi-permeable membranes from biology, if you took AP biology or biology class in college. The dollars themselves can't actually leave, or the currency can't leave its own cell. The only thing that can leave its cell are sort of these transmission signals, these sort of accounting claims and like assets and liabilities. And if you talk to an accounting person, they'll tell you about this term accounts payable and accounts receivable. And that's kind of how the nitty-gritty details of how this actually works. But the currencies themselves don't really move. in a sense. So that's sort of why global trade and domestic trade are actually fundamentally different in that sense, because you are crossing this semi-permeable membrane in which sort of you have in a way this like this, I forgot the biology term, but there's sort of this like osmotic pressure that builds up basically as the trade is to imbalance, and that osmotic pressure can only be alleviated in sort of these methods discussed down here. And I think there's something deeply sort of philosophical about that. So it did remind me of this verse from Galatians 3:28, where Paul says, "There is neither Jew nor Gentile, neither slave nor free, nor is there male and female, for you are all one in Christ Jesus." And yeah, I mean, can global trade be like that too, or are we stuck with this system? It's the interesting idea. Anyways, thanks for listening.